Good morning, everyone, and thank you all for being with us this morning for our VIP Listen and Learn event. Today, we have the privilege of listening to Dr. Thomas Lewis Jr., who will be discussing some of the most important business topics, such as how to handle accounting, bookkeeping, and taxes. So a little bit about Dr. Lewis. He is a graduate of Virginia Commonwealth University. Prior to the doctoral program, Dr. Lewis served in executive roles as the chief financial officer of a venture-backed mining and mineral company with operations in South Africa and Namibia, as well as the assistant director of finance and controller for the city of Norfolk. Prior to these roles, he worked at the Goldman Sachs Group, focusing on complex equity derivative solutions for a wide range of clients, and First Source Financial, monitoring the risk of a portfolio of senior debt. Dr. Lewis began his career with Ernst & Young, providing assurance and advisory services for Fortune 500 companies. He also earned an MBA from the University of Chicago Booth School of Business, is a certified internal auditor, and a certified public accountant in the Commonwealth of Virginia. Dr. Lewis researches the motivation and consequences of firms fulfilling their fiduciary obligations on behalf of all stakeholders, with a focus on the use of non-financial performance measures. Real quick, before we start, please take note of a few things. At the top of the chat, there are a few links for the Innovation Center. Our social media handle, website, and email is posted there. Also, there's a link to a post-event survey that we would like for you to fill out at the conclusion of the presentation today. Lastly, please remember to mute your mics, and if you have any questions at any point during the presentation, please put them in the chat and we'll address them at the end of the presentation. So without further ado, Dr. Lewis.
Good morning, good morning, good morning all. How are you? You're muted, so I will take it that you are doing fine. Tiffany, I want to say thank you to you for that introduction. Dr. Alexander, I want to say thank you to you and the Norfolk State School of Business for giving me the opportunity to work with the Norfolk State Innovation Center. And last but not least, I'd like to thank all of you for actually logging in today. I'm very excited. You know, I really get amped with the opportunity to speak with entrepreneurs. As you heard in my background, it's because I've actually been an entrepreneur. It's been one of the things that I've done in my career path. And I always like to take the opportunity to speak with people and just pass on my knowledge, not only my successes, but also my failures, things that I could have done better or wished I had known before I entered into that endeavor. So that's what we're going to do today. All right. And I'm going to take the time to start to share my screen with you right now. So bear with me one moment, please. All right. So the topic for today is we're going to take a look at accounting, bookkeeping, and just kind of give you some general overviews of things and considerations when we're talking about business taxes. All right. So again, we're going to start off by understanding, well, why is accounting important? Then what we're going to take a look at, we're going to look at the financial state primers. This is actually how accountants communicate. After that, we're going to try to really define the difference between accounting and bookkeeping, because so many people think that that's synonymous. And last but not least, we're going to take some general overview of things that you might want to consider in regards to your business taxes. And I'll leave some time to open up and field some questions after that as well. All right. So this is the pathway vision model. What I want to do is I want to draw your attention to the left-hand side of this presentation, right? What you're looking at on the left-hand side of the presentation is when a survey was taken, it's the public's general view of accounting. They really look at it as being data and rules. They look at it from a top-down perspective. It's data, it's rules, it's black and white. And oh yeah, at the end, you produce some type of papers or some type of reports, right? But if you veer off to the right-hand side of this equation, this is really the truth about accounting. Instead of it being a top-down process, it really is a bottom-up process. Instead of the end goal being the generation of some papers or reports, it actually begins with the economic activity of your company. And it really takes into account a lot of judgments. And the actual end goal of accounting is to produce information so that an end user can make a good decision. That's really what accounting is all about. All right, so again, why is accounting important to you? You're an entrepreneur. You've come up with this great idea that is going to change the world. And quite frankly, it's going to make you a lot of money, right? So your whole emphasis right now is, how do I get this product to market? How do I get it out there, let people know about it? How do I necessarily fund this endeavor, right? Why do I really need to think about accounting? Why is it something that's going to be important? Well, again, I venture to say to you that it is very important, because in order for you to do the things that you want to do, to get your product out to market, let people know about it, raise the funds that you're going to need to do all of those things, you need to be able to craft a story. Craft the story about your product, craft the story about yourself as an entrepreneur. And I venture to say that accounting is that story. Accounting is really an information system that ultimately allows you to do what? Identify your business activities. In telling your story, part of telling your story, if you're looking for investors, they want to know, okay, how much money have you made? How much money does it take for you to do what you say you do? So accounting identifies business activities. It also measures those transactions for you, right? You want to start your business. You want to start your business with $2,000, right? Okay. So how much money does your business have? And more importantly, how much does your business owe you being a shareholder? It measures those transactions. It identifies the activities. And last but not least, it helps you to communicate results of your business activities, of your transactions to specified end users. Now, who might those end users of information necessarily be? Well, those end users could be people who are external to the company, people like potential investors, people like creditors, or they could actually be people who are internal to the company as well. It could be you, right? I mean, in part of doing this, what type of information is accounting communicating? It's communicating financial information. So if you're trying to project your sales for the next quarter or the next year, where are you going to get that information? I mean, it's probably going to be predicated upon historical information. How are you tracking and keeping that information? So all in all, accounting is about communicating the story of your company to end users, people who are external to the company or people who are internal to the company, so that they are able to make business decisions. All right. And of course, if we're communicating information to people who are external to the company, there needs to be some standardized form in the way that we communicate. And that form are what we call the financial statements. These are documents that are used to communicate this financial information to end users. All right. Especially these, again, the external users of this information, we're talking about people who may want to potentially invest in your company. If anybody follows the stock market, when we're talking about buying shares of companies, these are what we call equity investors. Or it could potentially be people who you need to borrow money from. These are called creditors or debt investors, right? So if we are trying to produce information that these people can look at and make a decision whether they want to lend or potentially invest in our company, there needs to be some type of standardization. We can't present one set of information to one investors and another set of information to another investors, all right? So we have standardized financial statements that are governed by not only the Securities and Exchange Commission, but generally accepted accounting principles and by an organization called the FASB, right? So when we are communicating specifically to external investors, we're using statements. We're using statements called the income statement, statement of retained earnings, balance sheet, and a statement of cash flow. So let's start off with this income statement. Another way to think about the income statement is this is your statement of operations. All right. If you sell shirts, the income statement is going to show information about how profitable you have been selling shirts. And for those of you who are not that sure about how you calculate your profitability, it's really quite simple. The income statement is going to show the revenues, the money that you took in for selling shirts, minus the expenses that it also cost you to sell those shirts. All right. And the difference between those two is either going to generate net income or net loss. And here's a simple representation of the income statement. So again, if you provide some type of service, you see the service revenue of $8,500. The expenses that it took you to provide those services, in this example, you paid rent and you paid salaries to your employees. So you had service revenue of $8,500, you had total expenses of $3,200, and you have net income of $5,300. All right, so this is this is a simplistic form of an income statement. But basically, again, this statement is there to show some end user, some decision maker, how your company actually operates. If this is what you say you do, how much money do you make? How much did it cost you? And what is your net income? Net income is going to be very important, especially to potential investors, right? Because if I'm investing in your company, if I'm buying shares in your company, what am I buying shares in? I'm buying shares, in essence, to get net income. That's what I'm investing in. Whenever you look at CNBC and they talk about stock price is always driven by earnings. Earnings and net income are synonymous. This is what the net income is, what your company has earned by doing what it does. All right. And that is a perfect segue into our next statement. So the income statement or the statement of operation shows how profitable a company is. The statement of retained earnings informs users about how much of the earnings or how much of that net income has the company been able to keep or reinvest. All right. And it's calculated by taking the beginning balance. All right. So this is our very first year, obviously we have no retained earnings, right? So our beginning balance would be zero. And what do you add to it? You add to it the net income, or you subtract from it if your company had a net loss. And you also subtract from it if your company pays any dividends to get your ending retained earnings balance. So again, in our example here, we started off this company, this is year one. So we have no beginning retained earning balance. When we looked at our income statement on the last slide, we had net income of $5,300. Again, that's what we made from doing what we said we did. Subtract dividends. What are dividends? Some people might ask. Dividends are the return of that net income to the shareholders. So again, a potential investor might invest or buy shares in a company because they want the money that that company is ultimately going to generate. So if that company has net income, a return of that money on a per share basis is returned to the shareholders via a dividend. So obviously, if we have net income, dividends are going to come out of that net income. So we had net income, we returned $5,000 to our shareholders. So that left a retained earnings balance of $300. And again, the name says it for itself. It's the earnings that the company has actually retained or that they hold on to. Now, this is also important because it takes us into our segue of our next financial statement, and that is the balance sheet or the statement of financial position. So, whereas the income statement showed the actual profitability of the company, the balance sheet is showing you the financial position, right? So, I say that this is akin to if the income statement was your monthly budget or your annual budget at home. You get your paycheck, you take out all of your expenses, and what you have left that month or that year, that's what your income or your disposable income is. A balance sheet will be your financial position. So a balance sheet would be akin to if you own a home and your home is, you paid $200,000 for it. All right. That home is an asset to you. However, the home has a $150,000 mortgage on it, and that mortgage would be akin to a liability, right? So the statement of financial position in that respect, what is your financial position? If you have an asset worth 200,000, but you have a liability worth of 150 of a mortgage, then the amount of equity that you really have in that home is only worth about $50,000, right? So this is how you can look at the balance sheet. It provides information about the resources or the assets of the company, as well as the debts that the company owes, its liabilities. All right, and this is again going to allow a decision maker to determine the actual opinion about the company's financial position. This is not the same thing as the profitability of the company. It's sitting back looking at a company's financial position. And this is actually how we construct the balance sheet. Our assets or the economic resources of the company are equal to its liabilities plus its stockholders' equity. And here's an example of the balance sheet. So as you see, the assets are things like cash, accounts receivable, office supplies, and lands. And you have total assets of $30,500. You have liabilities, accounts payable of $200. And then this section right here is what I like to call this is a company's assets are equal to its liabilities. Liabilities are what it owes externally. And a simple way of me to think about stockholders' equity are what a company owes to its shareholders, right? So the common stock represents the price that the shareholders paid for shares in the company. And as you see here, this $300 balance is what? We pulled this $300 balance from our statement of retained earnings. Our income statement showed our profitability. Let's take a look. Income statement showed that we had a profitability of $5,300, right? We returned 5,000 of that to our shareholders in dividends, which left the company with $300 in retained earnings. So this is where we're pulling that retained earnings balance, right? So in essence, we're saying, what does the company actually owe its shareholders? The $3,000 that they've invested for the shares of stock, plus the $300 of earnings that they retained this year. So again, you will see that our total assets are equal to what? Our liabilities, what we owe externally, plus what we owe, what the company owes to its shareholders, $30,300. So our assets are equal to our total liabilities and our stockholders' equity. So in essence, that's why they call this a balance sheet, because assets equal liabilities plus stockholders' equity. And this is our statement of financial position. All right. This is telling us that right now in our bank account, we've got $9,000. It's telling us that someone owes us for the services that we provided. They owe us an additional $1,000. It's showing us here that we have office supplies that we have not used yet. They could be sitting in a bin of $500. And it's also telling us that we have land that is currently worth $20,000 on our books. All right, this is telling us that right now we owe someone $200. And again, this shows how much our shareholders have paid for our stock and the earnings that we have actually made and retained up to this point. So this is, again, it's showing the total financial position of our company at this point in time. So again, each one of these financial statements is telling a different story. One is telling about profitability, one is calculating our retained earnings, and another up to this point is showing our company's overall financial position. All right. And last but certainly not least, our last statement is our statement of cash flow. And this is actually going to report on the business's cash receipts and cash payments for a period of time. This is, how would I put it? This is basically looking at your checking account, right? This is saying how much money has actually come in and how much money has actually gone out over this specific period in time. Now, some of you might be saying, okay, well, how does this necessarily differ from the income statement or the profitability, right? If that is looking at our revenues minus our expenses and it's giving us whether we made money or whether we didn't, how does this really differ? Well, the statement of cash flows takes a look at your cash flow from your operating activities, your investing activities, and your financing activities as well. But one thing I'd like to show you is how it could potentially be different is right here from your operations. When you're looking at the statement of cash flow, it's only taking into account the cash inflows and the cash outflows. So when we look at collections from customers, here it's showing that we collected $7,500 from our customers over this period, right? However, if we go back, bear with me, to our income statement is telling us that we have service revenue of $8,500, right? So that's what, $1,000 higher than what our statement of cash flow is actually saying that we had, right? So did we really not have the service revenue? No, we did have the service revenue. We performed the service for whoever, right? But if you go back to our balance sheet, which is also showing our financial position, it's showing us that we have accounts receivable for $1,000. Accounts receivable is something that you have when someone owes you money. So think about it in your own daily life. Sometimes you pay with cash, sometimes you might pay with a card, right? So accounts receivable is akin to someone paid us, but they did not pay us in cash. So technically, we don't have that $1,000 in our bank account. That $1,000 is not sitting in our cash balance. It's a receivable. We're waiting to get that. And although that is good and we're booking that as revenue, you can't pay your bills with a receivable, right? So our statement of cash flow is only taking into account the amount, the inflows and the outflows of cash, and letting us know specifically what is our cash balance at any given point in time. And I hope that you can see it and especially appreciate this as an entrepreneur. This is something that's very important. You could do a big job, especially any of those of you who are in government contracting, right? Especially if you have reimbursable expenses, or even if you aren't paid after a job is done. You may know that the government is going to pay you. However, you could still have a cash flow issue, right? If the government is going to pay you a month from now, but your payroll is due in a week, that could potentially, be an issue for you, especially if you don't have a line of credit that can float you for that point in time. So again, each one of these financial statements, they're standardized. You may have a look at different companies in different industries. Those companies may have different accounts, but the format of each one of these financial statements, it's going to be consistent. Everyone's balance sheet is going to have assets, liabilities, and stockholders' equity. everyone's income statement is going to have revenues, expenses, and that's very simplistic, right? Everyone's cash flow statement is going to have cash flow from operations, from financing and investing. Everyone's going to calculate the retained earnings the exact same way. And this is very important, right? I mean, this is very important to you as an entrepreneur, one, because now you're starting to understand the language that your banker is speaking about when you go in for a loan. You're starting to understand the language that potential investors they're looking for when you approach them, maybe on the second time. Maybe you have a great first pitch, but when they want to start to get into the nuts and bolts of your business and what you do, these are the standardized reports and the way that they are actually going to be looking for that information to be presented. All right, so when we take this picture as a whole, income statement, that's summing up your operations, what you do, your revenues, minus the expenses that it takes for you to produce those revenues. Our balance sheet is an overall picture of the worth of our company. Our assets are equal to what we owe externally as well as what we owe to our shareholders. And our statement of cash flow is really the sanity check, right? That's how much green do you have at this given point in time, at whatever your reporting period is, end of the year, end of the month, what have you. All right, so the income statement is going to, its ultimate end goal is to show us what our company's net income is. The statement of cash flow to show us our cash position, balance sheet, show us our net worth, but also capture those type of transactions like depreciation, amortization that I guess are not non-physical type of transactions, but that are also ultimately going to show as expenses that are going to affect our income statement. So who's really looking at the income statement? Not only potential equity investors, but also the management team. If you are managing your own business, you are very concerned with your revenues as well as your expenses, because they ultimately are going to dictate whether you're generating income or whether you're sustaining losses. Who's looking at the balance sheet? Not only a potential board of directors, but your creditors. Why are your creditors so focused more on your balance sheet, whereas maybe your equity investors are focused on the income statement? As I said before, when you purchase stock in a company, what are you really getting? What is your return? You're getting the income that that company is actually generating. And the more income or earnings that a company has, it typically does what to their stock price? It increases their stock price. So if you're an equity investor, you're receiving dividends, which are your portion of its net income. Or if the company isn't paying dividends, the company is becoming what? More profitable. So therefore, the share price of the company is going to what? Increase. And so if you're an equity investor, you will also benefit when you do what? When you sell your shares, if the profitability of the company is also increasing. So that's one reason why investors are so focused on the income statement. Creditors, on the other hand, why does a creditor lend money? A creditor doesn't lend money just so that you can return its money. A creditor lends money for what? The revenue streams, for the interest. Typically bonds are issued in $1,000 denominations. That means that that creditor will give you $1,000, let's just say for a 10-year period. What does that creditor expect? At the end of 10 years, the creditor expects their $1,000 back. However, every single year, they expect an interest payment dictated by a predetermined interest rate, right? So a creditor wants to know, so in essence, a creditor is paying you for a fixed income stream over the life of that bond. So what does a creditor want to do? Yes, they want to know that you are making enough money that you'll be able to pay them back. But whereas an investor, if your company goes bankrupt, the equity investor has lost all of their money because your shares are worthless. A creditor has standing. So what does that mean? That means that if your company goes bankrupt, a creditor will typically, what will happen is that all of your assets will be sold off. And whatever money is generated from those assets, your creditors have certain standing or position. So therefore, whatever money is generated from the sale of those assets, a creditor can get a portion of that. Now, obviously, it's not going to be 100%. Most times it's not even 80%, right? But if you can get 20%, 20 cents on every dollar that you've lent in the event that the company goes bust, that's better than nothing. So creditors are really also going to be focused on your balance sheet or your statement of financial position. They want to see, what assets do you have? What liabilities do you have? Am I your only creditor? Am I your largest creditor? What position am I going to be in the unfortunate event if you go bankrupt? How much of my investment might I be able to recoup? And they're going to see this via your balance sheet. All right, and obviously everybody, management team, board of directors, creditors, investors, everyone is interested in how much cash we have on hand. All right, so now that we have kind of highlighted what accounting is, that accounting is really the presentation of information so that people can make informed decisions, how does that differ from bookkeeping? I mean, I hear people use that term interchangeably. Now, bookkeeping is the process of recording financial transactions for a business. So you might be scratching your head, okay, Dr. Lewis, but what does that mean? Think about it. We said that you as a business owner have to craft a story, right? And that accounting is your voice. It's how you're actually telling that story. So if I put this in story terms, accounting is, and they lived happily ever after. Bookkeeping is once upon a time. All right. Accounting is built off of bookkeeping. Bookkeeping is taking every single one of your financial transactions and actually logging that. Accounting is the culmination or the aggregation of the data that you log in bookkeeping. All right. So as an example, if you issue a bill to your customer, you're issuing an invoice to your customer. You've performed some type of service. Let's keep it and say we performed a service for someone and charged them $1,000, right? The issuance of that invoice to your customer and keeping track. This is your account receivable, that 30, 60, 90, whether they have paid you in 30 days, 60 days, 90 days. If it's gone past 90 days, whether you need to start some type of collection proceeding. That is something that's kept track of in regards to bookkeeping. All right. Accounting is going to show your accounts receivable at the end of the period, but keeping track of that is bookkeeping. All right, recording the actual receipts to the client. You sent this client this invoice, right? Now the client has actually mailed the invoice back in with payment. Logging that payment, making sure that receipt is actually logged into your type of system. Again, that is bookkeeping. The actual generation of where that is going to show up, the generation of your balance sheet at the end of your period, that is accounting. Keeping track of that is bookkeeping. Verification of invoice from suppliers. When you order your supplies, keeping track that you've paid for that and keeping the source documentation as well. Verifying that. Keeping track of all those records, that is bookkeeping. All right. And also, again, processing of employee pay. So just to show a visual representation of what I'm saying, On the left, you see a bookkeeping versus accounting. Bookkeeping focuses on the recording of the transactions, where accounting focuses on the analysis of the financial data at the end of the day. Bookkeeping classifies and records financial transactions, where accounting assists with the key financial planning of decisions. Bookkeeping archives and stores these documents. Accounting provides overview of the bookkeeping process. Bookkeeping will prepare and provide reports. Accountants will come in and adjust the data or adjust those reports for tax or other reporting type of purposes. All right. Bookkeeping in today's day and age, there are a lot of great programs that you can necessarily utilize. In regards to your source documentation these days, many companies no longer send paper bills or paper invoices. Things are sent via email, they're sent via PDF. So as far as the technology, it has simplified this. No longer do you have to keep huge file cabinets, right? You can keep, large files on your computer or store it on Dropbox, right? Which gives a listing of all your invoices and invoices that you've marked paid and receipts. And we have bank statements that come in PDF form, right? But as far as the preparation of your financial statements, the preparation of your taxes and things of that nature, that's all the role of an accountant as opposed to a bookkeeper. That's one reason why a bookkeeper or using bookkeeping technology these days can be very cost efficient or more cost efficient than it was in the past because it isn't as time consuming. Whereas the expertise that you get from your accountant obviously is going to come at a higher cost. Now, you're going to need an accountant initially to help set you up. Even when you get the accounting software, chart of accounts are going to have to be performed. There are going to be some other things that startups that you're going to need. But after you get your accountant to set those things up and to make sure that they are working as properly as you need, either, I don't know, your time or your inclination, but some of the software and the support, you could do it, you could have someone else do it, or again, you can employ a bookkeeper. But either way, the data is something that is going to have to be done. Because if you let the record keeping and the transactions, if you let all of that slide, it's going to cost you more in the long run because at the end of the year or at the end of your reporting cycle, you are going to have an accountant to come in to generate those financial statements. And those financial statements are built upon the data that is collected on a daily, weekly, monthly basis and aggregated by your bookkeeper. All right. So I hope that this is kind of solidified for you the importance of accounting, importance of telling your story, and also understanding the way that that story needs to be communicated to people who are both external and internal to your company. And I hope that now this kind of clarifies the difference between both bookkeeping and accounting and how both of these are integral and key to you on an ongoing basis as an entrepreneur. All right, so now I want to kind of slide into some considerations that you as an entrepreneur and as a business, you really need to, concern yourself with. Again, no one is expecting you to be an accountant. No one is expecting you to be a bookkeeper. But as a business owner, these are some things that you need to be aware of, and you need to seek the proper counsel. And in so doing, these are some of the questions that you need to raise or address with your counsel. All right, so as I like to tell my students, I always like to start with the why and not the how. So as an example of that, if you were driving, why are you driving? Obviously, you are driving because you want to get somewhere. That's the why. The how is I put my car in reverse, I push the accelerator, I turn around, I put my car in drive, I press the accelerator, I move forward. That is the how, but this is the why. So I think the why, we need to first look at taxes just in general. Now, per our fiscal year 2020 federal budget for the period October 1st, 2019 to September 30th, 2020, these are some figures. Now we're talking about the fiscal year 2020 budget for the US government. The US government's revenue was $3.42 trillion. All right, that was the revenue. Now the spending, unfortunately, was 6.55 trillion over that period, creating a deficit of $3.13 trillion. All right, those are just the facts. But what I want to draw your attention to is the revenue, right? Well, why am I doing this? Because we're talking about taxes, right? What comprises this $3.42 trillion in revenue for the federal government? Well, out of that 3.42 trillion of revenue for the federal government, individual income taxes represented 1.61 trillion, or 47%. All right, as we sit here on February 24th, I think that we all know what happens on April the 15th. So again, out of the $3.42 trillion of revenue for the US, for the United States of America in their federal budget, FY 2020, individual income taxes represented 47% of that revenue. All right, correspondingly, our payroll taxes, which go to fund Social Security and Medicare, these are social insurance programs, represented $1.31 trillion. So that was 38% of the federal revenue. Corporate taxes represented 212 billion, or actually only 6%. All right, so can we say that again? Individual income taxes represented 47%, and corporate taxes represented 6% of the total US revenue. And the remaining came from things like excise taxes, customs duties, estate taxes, and other miscellaneous sources, right? So the bottom line that I'm trying to get you to focus on here, or the why, is that the way you structure your business matters. Individual income represents 47% of revenue, whereas corporate taxes represented only 6%. All right. So what do I mean by that? All right. So when we say corporate taxes in the last slide, we're specifically talking about C corporations versus other entities, which are going to be your pass-through entities. All right. So let's just start with a C corp and talk about the tax ramifications there. Now, C corporations pay entity level income tax. All right, so that means if your company is a C corporation, your company makes revenue minus your expenses, bam, that operating income is actually taxed, right, at that corporate level. Then, like we said, if you are a stockholder, when dividends are remitted back to you or paid to you, those dividends are then taxed to you personally, right? So that's the reason why they say there's double taxation with C corps, right? It's because you are paying, the C corp itself pays taxes at the entity level, and then you as a shareholder, when you get those dividends, you are paying taxes, all right? And then of course, if you are a shareholder, when you actually sell your shares, you're also taxed, right? Well, on December 22nd, 2017, Congress passed this Tax Cut and Jobs Act that went into effect in 2018. And basically, this created a flat 21% federal income tax rate for C corps. And prior to that, C corps had been taxed at a rate as high as 35%. All right, that's one reason why you saw on the previous slide, corporate taxes in 2020 represented 6% of the revenue, as in comparison, I believe back in 2016, they represented 9%. That's part of one of the reasons why. All right, so the C corp tax rate has fallen to a flat 21%. So if you're a C corp, revenues minus your expenses, you got your operating income, now it's taxed at a flat 21%. All right, but you might sit back and say, okay, but what about the dividends as well as the cap gains? Well, tax rates on qualified dividends, there could be 0%, 15%, or 20%, depending upon your taxable income and your filing status. All right. And capital gains tax rates are either 0%, 15%, or 20% at the most for assets that are long term, meaning that they are held for more than a year, more than 12 months. And any asset that is sold prior to that or short term, the tax on that typically corresponds to your ordinary income tax brackets. All right. So that's the consequence for you if you are set up as a C Corp. Now, if you're set up as a pass-through entity, what's a pass-through entity? A pass-through entity is going to be your sole props. It's going to be your partnerships. They're going to be your limited liability companies. They're going to be your S Corps. This is when your business has revenue minus expenses. The income that your business actually generates is then seen as part of your personal income. And it could be based on your pro rata share. What do I mean by that? If you're a partnership and it's 50-50, your partnership makes $100, all right? So that $50 of that, whether you spend it, whether you pull it out or not, if you're a partner, it's a 50-50 partnership, 50 of that $100 is going to be reported in your gross income for you personally, your personal income. All right. So that's the way it works for pass-through entities, right? Which is pretty much just about everything outside of a C Corp. Why does that matter? Because if you actually go to your marginal tax rates, if you go to the how you construct your personal income tax liability, first of all, it depends upon your filing status. Are you filing as a single? Are you married, filing jointly, married, filing separately, head of household, right? And then it's going to also be dictated upon how much your taxable income is. That's going to dictate how much taxes you pay. And in the United States, we have a progressive tax system. What does that mean? It means that as your tax base increases, the more money you make, the higher the rate that you will pay. All right. And so that's the way that that means. So you can only imagine that if you have a side business or you have a business that's a pass-through entity, all of the income of that business, whether you are pulling it out or whether you're reinvesting it back into the business, is going to be taxed to you at your individual income rate. Why is this important? Because in that same Tax and Jobs Cut Act, what happened? Now, the tax rates for individuals did drop, but they didn't drop by that much. The highest marginal tax rate for individuals was 39.6%. This act dropped it to 37%. Again, now compare that to C Corps. C Corps were taxed at 35% prior to this, and now this created a 21% flat tax for them. And again, look at the marginal tax rate for individuals and even compare that to the dividend tax or the capital gains tax. And what happens in addition is the vast majority of people who own stock and a lot of the business owners as well, their marginal tax rates are typically above 20%. All right. So the moral of this story is that for the vast majority of people, and again, this is all going to be situational based, but what's your status, and go look at what your income has been over the last 2 or 3 years, and look at what your marginal tax rate is, and you can compare for yourself and see what necessarily works better. But it's quite obvious that the rates for C Corps and even rates that people pay on cap gains and dividends are typically lower than what their marginal tax rates are. All right. Another key piece of this legislation is that all of the changes that were enacted for the C Corps, right, those are permanent changes, whereas the changes that have been enacted in regards to the individuals, and that's the pass-through, those expire at the end of 2025 if Congress doesn't elect to extend those. All right. One other thing that the pass-through entities did get in this act, though, they got something, the QBI, which is the Qualified Business Income Deduction, and it does allow eligible self-employed and small business owners to deduct up to 20% of their qualified business income on their taxes. But this is also subject to, a host of income limitations. So the moral of this story here is that you need to seek professional advice, specifically in what is going to be best for you as far as how you structure your company. And again, this may change as your company grows and your company evolves. Maybe initially, and I see this for a lot of people, initially start off in some form of pass-through entity. But as time moves on, maybe you need to change your structure. So this is why you need to employ the services of a skilled tax professional. Something that you also want to take consideration of as business owners are payroll taxes, right? These are taxes paid on wage and salaries of employees that are also used to finance those social insurance programs that we talked about, or FICA, which is Federal Insurance Contribution Act. If you're an employee, look at your check sometime. Sometime on your check, you're going to see this thing called OASDI. It stands for Old Age Survivor Disability Insurance. This is known as what people affectionately know as Social Security. All right. And Social Security in total has a 12.4% tax, and that's on income that you make up to $137,700 for 2020. All right, this is called a regressive tax. Why do we call it a regressive tax? It's because you are not going to pay 12.4% again after on any income that you make after 137,700. Now, 6.2% of that 12.4 is remitted directly by employers, while half of that is taken out of your worker's paycheck. So if you're a worker or an employee, you go to your paycheck and look for OASDI, and that will be 6.2% of whatever your gross income amount for that month, that 2 weeks, that quarter, whatever have you. That's what that's going to be. And your employer is responsible for remitting their half of that as well. If you go to your check and you look and you see HI or the high, that is actually the Medicare payment. Now that's going to be 2.9% of the total income, and there is no income limit on that. 1.45% is remitted directly by the employer, while the other 1.5% is taken out of the worker's paycheck. So the bottom line here is employees are responsible for 7.65% of FICA. That's the 6.2% of your Social Security and the 1.45% of the Medicare. And self-employed people pay the full 15.3%. All right. The only other thing that I want you to be conscious of as well is this unemployment tax, or the FUTA, that is paid solely by employers, right? If either one of these apply. And again, I think that this is very timely when we look at, the circumstances around COVID as such, right? So if employers pay wages totaling at least $1,500 in a quarter, and an employer has at least one employee on any given day for 20 weeks in a calendar year, regardless of whether the weeks are consecutive or not. All right, the FUTA tax rate is 6% in 2020, and it's imposed on the first 7,000 of wages for each employee. All right, if you pay your state unemployment taxes when due, you're allowed to claim 5.4% credit on your federal unemployment tax, which effectively reduces the federal unemployment tax rate to 0.6%. All right, so what I've been focusing on right now are federal taxes. So you need to also have the understanding that state taxes are also going to apply, and you also have a SUTA. This is FUTA, the federal unemployment tax, right? And you also have a state unemployment tax as well. All right, so I'm going to leave it right there at this point in time, and I'm going to open it up to any questions in the 5 minutes or so that we have left. Thank you.
Thank you, Dr. Lewis. Actually, we do have 2 questions. The first one is, what is the best software we can use to do our bookkeeping and create financial statements?
That's funny. I'm not a paid spokesperson for any software. You know, I'll put the caveat that there is a large software provider that plays a lot of commercials during the Super Bowl that in the past I have done some, you know, testing, consulting for, and I've actually done some tax work for. So I'll just leave it there. There are a number that are out there. So I would sit back and again, it doesn't take the place of first speaking to a qualified CPA or tax professional to get it set up. And I think that whoever you go to, they can definitely lead you in a direction in regards to software. But I don't feel comfortable personally endorsing one software over the other right now.
All right, and then the next question is, when starting in an LLC, what is the best way to set up, C Corp or S Corp?
Well, right there, the question is, a LLC is a different structure, is its own structure. A C Corp is a corporation. An S Corp is also a corporation. So a limited liability company is its own separate structure. So is the question, are you asking, should you set up an LLC? Should you set up an S Corp or should you set up a C Corp? Is that what the question is? I'm trying to get clarity.
They haven't responded yet.
Okay, well, here's the deal. I'll put it this way, right? First of all, corporate structure. This is the reason why this is something that has to be individual to you and your personal situation. But I'll put this out there. The corporate structure, the reason you structure your corporation or your business a certain way, it might have tax implications, it might have legal implications, right? One reason why you might structure yourself as a limited liability company, an LLC, is because it gives you legal cover, right? For all intents and purposes, you could act just like a sole proprietorship when you are set up as an LLC. But what happens if you get sued and you're a sole proprietor? You get sued, they can come after your personal assets. They can come after your home, they can come after your car. If you set yourself up as an LLC, it gives you that legal threshold, right? So that if you do something, your company gets sued, they can only get what's in that LLC. They can't come after your personal assets. So that's a different reason than tax. From a tax standpoint, if you're a sole proprietor, if you're a limited liability company, and if you are an S Corp, that's still a pass-through entity. An S Corp, you could be a shareholder in an S Corp. You know, I believe an S Corp can have up to 75, I believe, shareholders or so. But either way, like what we said, your business makes money. You know, let's just say for this example that, you know, our S Corp has 3 shareholders and we all equally own shares, right? Whatever income our S Corp makes, each one of us, from a tax standpoint, whether we spend the money or not, have to pay taxes at our own personal marginal tax rate on a third of that because there are 3 shareholders, right? So from a tax standpoint, you know, you're going to run into the same scenario from a tax standpoint if you're an S Corp, if you are a sole proprietor, if you're a partnership, or if you're an LLC. The C Corp is its own separate legal entity. But also with the C Corp, there are a lot of other processes that you necessarily need to go through. You need to have, you know, board, you need to have, you know, certain filings that you might not necessarily have to have as an LLC. So again, that's going to be so dependent upon you and what your needs are. I hope I answered your question.
All right, and real quick, just one more question. Do you currently consult for businesses? And if so, how may we get in contact with you?
I do. I do. I will actually make sure that I get my contact information over to the Innovation Center. I mean, they already have my contact information at school, but I'll get that over. Obviously, because of COVID, my first priority is being a professor at Norfolk State University and the challenges that this has presented for the semester. Typically around this time, I do a lot of consulting specifically on structures and taxes. but I've pretty much been focusing on my classes and on my research. But I'm always available. I'm available to the Innovation Center, and yeah, I would be able to, to carve out some time as needed for these type of questions offline.
All
All
right.
right.
Yep, that's all the questions. We would like to thank you, Dr. Lewis, for taking the time to present this important information. Once again, the links to contact the Innovation Center are in the chat at the beginning and at the end of the chat. This presentation will be available on our YouTube channel on Friday for everyone to view. And I just want to thank you all once again for coming to our event, and we hope to see you at our next event, which will be our Build Your Business Wednesday event on March 10th at 10. That event will focus on the Lean Canvas business plan. So once more, thank you for attending, and I hope everyone has a good day.
Thank you. Take care.
You too. Bye.
Thanks, Dr. Lewis. Bye.
Yeah.